We did see stocks dip around the world yesterday, starting first here with Asia. And of course, with more uncertainty, traders are opting for less risk. And that's driving up the U.S. dollar, which now stands near its highest in 2 weeks. And there could be more support for the greenback. Let's bring up this chart if we can. Well, the chart should show that we could expect more U.S. dollar strength in the future. U.S. dollar set to strengthen, as according to DBS. Let me just get some more on that chart for you that you see there on your screen. This strength in the U.S. dollar, especially against the euro, this could be driven by a narrowing U.S. trade deficit. And DBS says that this means the dollar will strengthen to about 130 on the euro, past 100 to the Japanese yen by the end of this year. Now, at the beginning of July, our next guest also predicted for U.S. dollar strength, and that's exactly where we are right now. So let's talk about dollar strength, especially against the euro and other currencies. We have Patrick Bennett from Societe Generale back on with us. Nice to see you once again, Patrick. So here we are, U.S. dollar strength, and you were saying go long on the U.S. dollar back in July, at the beginning of July. So what do you think about DBS's predictions? Is it the U.S. trade deficit narrowing, or is it something else?
I think it's a combination of factors, really. I mean, certainly that's been one aspect of it. But if we look back what has happened over the last couple of months, a lot of major markets have been in very well-defined ranges. I think there's been a lot of uncertainty out there that investors haven't been quite confident enough to look for trend gains. We're not convinced that we're into that situation just yet. But we certainly think that the dollar, cheaper than 140 against the euro, and is a good buy, and we expect to see some further gains in the weeks ahead. Yeah,
you're expecting 135 by September for the U.S. dollar.
Yeah, I mean, that seems quite a move from right where we are now.
Absolutely.
But we think stronger than 140 for the dollar is absolutely appropriate. The way to go from here.
Yeah, your predictions, Societe Generale's predictions, are actually stronger than for U.S. dollar strength, actually more bullish than other brokerages that we see, including Deutsche Bank, as you see there. Well, actually, Deutsche Bank pretty much in line, but Morgan Stanley and HSBC. What is it that you're seeing that maybe these banks aren't factoring in?
Well, I think the consensus views right now haven't been looking for much change at all. It's always a case of trying to anticipate when this information may start to impact. Our belief is that the US was first into this crisis. The US Fed and the Treasury were very aggressive, in their efforts to correct these imbalances, and they have done so. And so we expected the US economy to emerge first. We expected markets to start pricing, normalisation in interest rates and monetary policy, sooner, even though that's still a long way off. But once that starts to happen, those are the drivers which contribute to the dollar strengthening from here.
Yeah. So is it also a play on the differentials between the economies in Europe, which a lot of people say are in much bigger trouble than they are than the economy in the U.S.?
Yes, well, certainly. I mean, when we have extraordinary monetary policy, in other words, when rates are kept very, very low and we've got quantitative easing, we need to look for different metrics. And if we look at the metric just of growth and potential growth, then we're looking for the U.S. economy, to be the strongest of the major economies. Certainly much stronger than what we expect to see in Europe either this year or next year, and that is going to be a driver of dollar strength.
Yeah, and anything below 140. It's a good buying entry point.
Yes, anything below 140. Right today we're at what, 141 and a quarter, something like that. We don't expect it's going to be a one-way move. Markets are, very, quite liquid at the moment in these summer months, and it's a matter of looking for opportunity to, to instigate those trades.
Well, speaking of strength, you're expecting the yen to take flight, strengthening to 92 with the U.S. dollar by September and 95 by year's end. That's quite a long way from here, I would say. We're at 94 right now. What about those GDP figures yesterday? Did that impact maybe your calls?
Well, the GDP numbers were good. Certainly Japanese GDP was most contributed by net exports, not by this inventory build-up that we have been seeing elsewhere. We think that the outlook for Japan is much better relative to expectations of a couple of months ago. 90 is probably going to be a little bit of an overshoot in strength for the yen, but what's going to drive that for the moment is this move back to more less risk appetite that favours the dollar, that favours the yen. But once we see those matters evening out later in the year, then we see that the yen start to weaken and that dollar strength start to reassert itself.
Okay, so if you expect the yen to strengthen, that's why one of the plays that you're advising is to short the Aussie dollar versus the yen. And we did see a peak maybe a week and a half ago. I think at 82 was the level. But why do you think the Oz will underperform from here, especially as we hear that there's speculation that maybe interest rates may be on the rise down under?
Yes, certainly. I mean, the expectation that the RBA will be one of the first, or perhaps the first G10 central bank to raise rates is very well reflected in the markets right now, so we don't think that's a major driver of further strength from here. The Australian dollar, like a number of equity markets, like a number of commodity markets, has been a recipient of very strong liquidity out there in the global markets. There's liquidity that central banks around the world have provided. So as we start to see some unwinding of that, some unwinding of expectations that monetary policy will be kept so low and quantitative easing so aggressive for so long, we're expecting the Australian dollar to underperform. But really it's the weight of positioning unwinding rather than any downturn of what are still very strong fundamentals for the economy in Australia.
Yeah, what about the commodity story? If people are talking about the commodity story, maybe the Oz dollar is the best buy in the commodity sector. What do you think?
Yes, I mean, certainly we expect a number of economies, a number of currencies to do well, on the back of China, currencies which are, exporters of commodities. Australia is one of those, to be outperforming. We're looking now, though, when we talk about the currencies, perhaps the currencies, overshot levels right now. So we're looking for a correction as investors unwind these positions. The Australian dollar, underperforming, the yen, outperforming. But on a longer-term basis, we expect the Australian dollar, to be one of the stronger G10 currencies on a 2 to 3 year horizon.
Now you're favouring this I guess, this cross-currency play for next week, expecting the Oz dollar. There's your prediction potential target around 70.50 to 71. That's not going to hit those levels next week, right? Because we are quite high up from there.
Not next week for sure, but we're saying we favour this trade for the next week. We think there's going to be opportunities to be entering this trade this week that investors and traders, companies looking to hedge their receipts, should be looking over the next week to be entering this trade. As I mentioned earlier, we don't expect these moves to be one way in nature. There's a lot of very good flow of information out there in the market at the moment. But to have that in mind during this week and to be entering those trades, we think is a good time.
And the good entry points would be, is there a range there?
Well, certainly, I mean, 82, as you said, was the high. So I think, back towards 78, 80 or anywhere in that range is going to be good selling for the cross.
Okay, Patrick, stick around. We're going to talk more about currencies. And after this break, we're also going to focus in on the Indian rupee. It's falling below a key chart level. We'll take a look at what that means coming up next. And, of course, we'll continue our discussion with Patrick. So in the meantime, if you want, send us your emails, asiaedge@bloomberg.net. We'll see you after this. The charts, and for chart watchers, India's currency, the rupee, is at a key inflection point. And here with technical analysis, we have our Bloomberg Forex reporter, Patricia Louis, joining us from Singapore. And Tricia, the rupee, let's talk about the Indian currency, has slumped almost 2% just in the past 5 days alone, and has now broken through that 100-day moving average. So what does this signal?
Yes, Susan. Well, everyone was looking at this level very closely, and they were wondering whether the rupee will finally break the 100-day moving average, and it finally did, actually. It closed, the 100-day moving average was at 48.7, and yesterday the currency closed at 48.965. Now, this is the first time it's broken above the 100-day moving average since mid-May. Now, remember, mid-May, the rupee rallied because of the elections, and it's the first time since then it's broken up, and now the traders are, I spoke to Thomas Haar of Standard Chartered, and he cited 49 as the next psychological level. And 49, mind you, it also happens to be that 200-day moving average as well. So traders will be watching this very, very closely to see if it breaks above the 200-day moving average. That's certainly signaling a lot more losses for the rupee in the near term. Yesterday's 1.5% fall was actually the biggest since March the 2nd. And of course, the move was definitely in line with all the rest of the regional currencies and the regional stock markets. Susan?
Yeah, Trish, the rupee, I guess the best performer in the Asia-Pac year to date. But let me just ask you, when you talk to other traders and currency analysts, how much more upside is there on this currency, or is it just more downside from here on?
Oh, well, definitely in the near term, definitely a lot more downside. A break above that 200-day moving average. If we close above that today, traders will be targeting the next level, which is at the 49.70. Now, why 49.40? That was the gap back in mid-May when the rupee actually, when dollar rupee actually gapped down, open gap down because of the weekend election results. They're saying that, you know, in technical analysis, you need to close a gap, and this is actually what the dollar rupee is going to do. It's going to go back to close up the gap before it actually resumes the downtrend. So everyone will be watching very closely at all these key technical levels today. Susan?
Okay, Trish, thanks for that. Let's continue our discussion on currencies with Patrick Bennett of Societe Generale. And Patrick is also saying that the rupee, the Indian currency, is going to weaken from here on in.
Yeah, absolutely. I mean, we're looking for all of dollar Asia to, to track higher in the next few weeks. It's a combination of factors. One, the stronger dollar. Two, the unwinding of these risk trades in equity markets. And we're seeing now quite a strong confirmation in a number of markets that are all pointing the same way. Commodities are looking to point a little lower. Crude oil, we saw the Aussie yen earlier, the Indian, dollar Indian rupee and dollar Singapore, dollar Asia in general, bias higher over the next few weeks.
Yeah, you're looking for the Sing dollar in particular. This is one of your recommended trades, Sing dollar to weaken. That's more a reflection of weakness in the Singaporean economy, especially with those export figures. It's
a reflection of what's happening in the dollar. It's a reflection of what's happening in equity markets, in risk markets in general. And yes, I mean, the export numbers for Singapore yesterday, they were very near expectation, slightly better than expectation. But still, the levelling off is good in those numbers. But we're still not seeing a return to the very strong growth or trend levels that we saw, say, between 2005, 2007. We still think it's appropriate that the Singapore dollar is moderately weaker from current levels.
Yeah, an entry point once again for those watching at home in terms of
anywhere around the current market, 144.5 to 145, which is the range we're trading in right now. Is going to be a good level to be establishing those trades.
Okay, well, let's talk about those Asian currencies, because the last time you were on, Patrick, you were talking about the Korean won, expecting it to weaken to maybe a 13.35 versus the U.S. dollar. Now your predictions, you've retraced that a little bit. You're not expecting the won to weaken as much. Let me just ask you, what do you think has changed your mind in terms of scaling back expectations for won weakness?
I mean, for the won in particular, quite clearly the previous weakness in the won has helped the economy, considerably. Growth numbers have been better. The Bank of Korea, the government, are much more upbeat on what's happening there. Korea has quite clearly gained market share against its competitors in North Asia versus Taiwan, versus Japan. The weaker currency has helped that. So we're expecting to see more exporter flow, which will prevent the Korean won from weakening. We're seeing greater investor interest in buying Korean assets at what are going to be quite cheap levels still with the currency where it is.
Yeah, and also the rupiah, which is a very popular currency play considering how well it's done, especially after SBY won those elections. You're still calling for the currency to weaken, though, especially at after this outperformance so far.
Yes, we think it's perhaps gone just a little bit too far right now. Certainly a lot of the flow that's been involved into Indonesia has been very similar to flow that's been into equity markets. It's been driven by liquidity. It's been driven by a search for yield. It's been driven by risk appetite. We think that is going to be that's right to be unwound or consolidated rather right now, and that's going to result in in the rupee just easing from its current levels.
Okay, so let's break it down then. We talked about some of your key currency picks. That includes going long on the U.S. dollar versus the euro, maybe shorting the Oz versus the yen, and then also going long on the USD versus the Sing. But if an investor wanted to make money, say in the next 2 weeks or so, what is the best bet in currencies?
I mean, the best bet right now are those trades short of long of the dollar against euro and short of the Australian dollar against yen, because they encompass all the major factors which are happening right now. That is the dollar recovering as this risk appetite is being unwound. All of those those combination of currencies reflect those exactly those factors.
And do your choices change, say, a month out from here?
Yeah, I think a month out from here, I mean, we don't dislike the Australian dollar on a very long-term basis. We just think there's a need for some correction right now on a perhaps a 1 to 3 month horizon. We still expect the euro to be lower against the US dollar. We expect most dollar Asia pairs to be moderately higher from current levels right now.
Okay, Patrick, thank you for joining us today. Stay dry here in Hong Kong. Nice to see you. Patrick Bennett of Societe